this one's a quick one. Is there any factor ETF you recommend in Canada, like AVUV or AVDV? Is there a reason you didn't include AVES in your factor tilted portfolio? Manulife does have some factor ETFs. I think BlackRock does too. The Manulife ones are sub-advised by Dimensional. I think actually Vanguard has some stuff too. I'm not recommending any of those. We don't use them at PWL. I've not done proper due diligence on any of them. I just know that they exist. There are products out there. On AVES, we decided at the time, I mean, that model portfolio is many years old now and we have not updated it. But at the time, emerging markets are a relatively small portion of the portfolio. And one of the objectives in building that thing was to keep it as simple as possible, as few holdings as possible. And so and as few US dollar funds as possible, just to keep things simple for Canadians. And so we decided it didn't make sense to include it. But that's it. Not very exciting.
Have you looked at FEQT in any like great detail? Because I mean, they have some kind of factor exposure, and they tilt to things like low volatility and momentum and stuff, which I know is maybe less or more controversial. And there's some Bitcoin in there and stuff as well. But I mean, as far as like a one fund solution that might give you some factor exposure, it's Canadian, it's low fee. You don't have to stitch together some US ETFs and some higher fee ETFs. I'm curious if you've taken a look at it.
For me, the Bitcoin is a turnoff. I have looked at their factor products. They are much more concentrated than something like Dimensional. They're also much higher turnover. Like they're much more active. They've performed quite well, and they are targeting real factors. They're not. It's not like traditional active management with a factor label. It's quite quantitative. So I don't know. Like I probably wouldn't use it personally, but I don't think it's terrible.
Because of the Bitcoin?
The Bitcoin and the concentration and the high turnover. Like there's a lot of things I don't love about it.
Yeah,
The fact that it's targeting factors that probably should exist is good, and it seems to have been able to capture them so far. So that's all positive, but it's not an implementation that I would prefer to use. And then add the Bitcoin on top of that, and it's another reason for me to stay away.
Okay, have fun staying poor, Ben. You've mentioned before, Ben, that like in Canada it's tough to get exposure to factors, but a high yield dividend ETF might be a reasonable proxy for that, right? And I know you mentioned the Manulife multi-factor ETFs, but this particular question they were asking about US listed ETFs that are generally kind of world ETFs. And part of the problem there is if you do want to implement some home bias, those Avantis ETFs wouldn't have it if you're a Canadian investor. So I'm just curious if you have thoughts about like taking something like AVGE, which I think is global equity markets from Avantis, and then adding some home bias via like a VDY or like a high yield dividend ETF in Canada.
I guess. I don't know. You
Yeah.
could. The trade-offs with dividends are just like you've got the tax inefficiency. If it's in a non-taxable account, I guess it's whatever. But then you've got the reduction in diversification for no reason other than companies are not paying dividends. So similar-ish kind of concerns with the Fidelity stuff. Like it's going to be a more concentrated implementation. But I don't know, man. Like when you've got low fees and you're using a fund that's not tracking super speculative stuff, and you're going to stick with it. You're not going to sell out of it when it does poorly, or if it does poorly, it's probably fine. But like, is someone that does that, are they really going to stick with it and be disciplined and so on and so forth? I'd be a little bit skeptical. But there are so many ways to invest successfully. Like, yeah, index funds make sense, and yeah, some factor tilts can make sense. But like, if someone buys and holds a dividend fund for 40 years, they're probably going to be fine. It's not how I would do it. It's not how I would recommend doing it, but they're probably going to be fine if they stick with it.
Good stuff. Okay. Next one.
Yep.
Okay. When planning for retirement, people often mention the 4% rule. Ben and the RR crew have had multiple discussions laying out why the 4% rule is flawed and have offered alternatives such as a variable withdrawal rate, which we kind of just talked about. How would someone who is early in their career plan for retirement with this in mind? Is it acceptable to use a 4% withdrawal rate for long-term planning with the understanding that actual withdrawals will vary?
I think why the 4% rule became so popular, at least one of the reasons, is it's kind of easy to do the math in your head about how much you need to save for retirement. We had someone from the fire movement. His name is escaping me right now. He made a documentary. Oh, that's brutal. But he was on the podcast and talked about fire, and that was like a big thrust of it was that, well, the 4% rule just makes it so easy for us to think about our financial goals, and that makes it really easy to save, and that makes it really easy to invest and stay invested. Like, that's all pretty compelling. I think 4% is probably high, even if you're using variable withdrawals. But if you recognize that, it's probably not the end of the world, I guess. I looked at the DMS historical data for a 70-30 portfolio this time, and of global stocks and U.S. bonds going back to 1900, and found a safe withdrawal rate of 3.5% for 30 years. This is I was sitting down at a different time doing this analysis. That's why the numbers are different from the one that I mentioned earlier. And the safe withdrawal rate drops to around 3.1% if you're looking at a 40-year period. And that's both with about a 4% failure rate. If I switch to amortization-based withdrawals for spending, the failure rate mechanically goes to zero. You can't run out of money doing amortization-based withdrawals.
Sorry, do you want to just explain that quickly, Ben? Because I don't know that everyone knows what amortization-based withdrawals means. Sorry to cut you off, but I think we did talk about it with Ben Matthew, but I don't know that everyone listening to this will understand that.
It's basically using the Excel payment function to calculate how much you can sustainably spend in each year of retirement based on the expected return, remaining periods of retirement, and the remaining portfolio value with an ending portfolio value objective of zero. And that will mechanically, it'll change, the spending amount will change every year, which, as we just talked about, can be problematic in practice, but you will not run out of money in that case. Just because
more properly speaking, you will run out of money, but you will run out of money at the end of the period
correct.
That you've chosen. Okay, interesting.
That is exactly correct. Yeah. You will run out of money when you expect to.
Right.
But getting to that certainty about when you're going to run out of money or when the portfolio will be depleted, which itself is problematic, by the way, because you don't know when you need to run out of money. You don't know when you're gonna die. But if we assume that's known, you can kind of mechanically get there. But the trade-off is you can have more variability in your spending. Anyway, so in this case where we had 3.1% for 40 years, 3.5% for 30 years, if I ran amortization-based spending, I think for 30 years, the worst case spending is 3.7% of the starting portfolio on average, but there's a bunch of variability around that. Like the lowest spending year was 17,000. So I guess similar to the previous example in real terms, and that's compared to $35,000 in the safe withdrawal rate case. But then there are also higher years of spending, which kind of make up for it, but kind of not, because it's kind of hard to change your lifestyle materially every year. But at least financially, that's how it works. And then the other thing is that you don't run out of money. Like the safe withdrawal rate case has a 4% failure rate. So in that worst case, you are actually running out of money because I allowed for an above zero failure rate. But in the amortization-based withdrawals case, the portfolio is depleted exactly when you expect it to be depleted, like we talked about earlier. So all that to say, if you allow some form of variable spending, amortization-based withdrawals being one of them, you can have a higher average spending amount, but it's still below 4%. So again, it's simple math. And I think if it helps people save and invest and stay invested, that's great. But I think you do have to be a little bit careful.
Yeah, I think it works well. Like the question was specifically for someone who's earlier in their career, right? And so if you need some kind of real simple rule of thumb that you can keep in your back pocket as a target, I think it's fine. Like you're probably, you're talking about withdrawal rates of 3.7%. Like you're within spitting distance of it. And yeah, it's materially different than 4%. The 4% rule doesn't tell you what your after-tax spending is, because is it 4% from an RSP or 4% from a TFSA? And you're going to have materially different outcomes in terms of your after-tax spending. But if I'm 30 and I've got 35 years before retirement and I just need to throw a target out there, I think it's fine as a shortcut, as a heuristic, right? I would never base an actual retirement spending and withdrawal plan on the 4% rule. But if I'm on the other side of retirement with a long time horizon until I get there, and I just want something to aim for, I think it's as good a rule as we can make.
Yeah, I like it too. Like you said, I mean, you're not going to base a financial plan on it, but if you're just sort of looking ahead and, how many people have you spoken to are kind of, younger people or a fairly long way from retirement? They literally have absolutely no clue how much they will need to retire. And there have been surveys about this, and people are wildly off the mark, both high and low, right? So again, if you're just sort of saying, well, how much do you spend this year? Well, I spend $50,000 a year. Well, okay, if you had $1 million, at 5%, that's 50,000. Just a starting point for the discussion, right? So it might be able to identify people who are saving not nearly enough, right? Like if you just kind of look at what you're spending or what you want to withdraw from your portfolio, and it's 12% of your portfolio, then like, okay, you need to do some math now and figure it out. Not a financial plan, but it is not the worst rule of thumb I've ever heard. I will say that. I feel like it's a bit maligned, like unfairly. I don't think Bengen, when he invented it, expected it to be a law. It was just a guideline, right?
When he never called it the 4% rule either, right? Like that was kind of bastardized after the original paper came out, right?
Yeah. We did an episode with him, episode 135. Talked about.
How do you remember that? I was going to ask this. Like sometimes when you guys talk about a previous episode, and Cameron used to do this all the time, it's just like episode 241 at minute 17 for those who are listening. Like, how did you know that so fast?
Well, I'm not that smart. It's because I just did that video on sequence of returns risk.
Okay.
And in the video, I mentioned Bengen and the episode number, so I had it fresh in my head.
That makes me feel better. Cool. Okay. Anything else on the 4% rule?
I don't think we've already, because it did come up with the whole variable withdrawal idea.
Yeah. The variable withdrawal stuff is so interesting because it's like Bengen, a financial planner, comes up with the 4% rule. And if you ask an economist, it's like the worst rule ever. And Robert Merton came up with amortization-based withdrawals in like 1969, I think. And nobody uses amortization-based withdrawals, even though if you ask an economist, that's what they should be doing.
Like in practice, nobody uses it.
Correct.
Yeah, of course.
And like Ben Matthew, we'd had that great episode with him talking about amortization-based withdrawals and why it makes sense. Mm-hmm. But you tell it to a client, you tell it to most people, and you're like, yeah, I don't want to do that. There are probably ways to make it more palatable though. Like I think you could, I don't know if we talked about this in the episode or if Ben and I talked about it offline. But you can do stuff like you can smooth it, so you're not making big dramatic adjustments. You could probably adjust less frequently, but it could still be big adjustments. Yeah, I don't know. I agree with you, Dan. If you've done a really good retirement plan and the person's not wanting to optimize as much as possible, optimize their utility, because most people don't know what that means, and doing the normal way of financial planning with a Monte Carlo simulation, maybe making some adjustments along the way, but planning for more constant spending, it seems to be a lot more palatable to most people.
Yep.
Just buy an annuity, be done with it.
Buy an annuity? Well, so in amortization-based withdrawals, like in that sort of life cycle approach to financial planning, the way that you would fix spending is by building a TIPS or a real return bond ladder. Like, okay, I don't want that much variability in my spending. Okay, the way you solve for that is by building a bond ladder that's going to pay you exactly what you want as a floor throughout your retirement. But that also can pretty materially reduce the amount that you can spend throughout retirement. So, yeah.
Hardest, nastiest problem in finance, I think Bill Sharp said, right?
That's right.
Something along those lines. Okay. Next one?
Yep.
Dan, you want to read it out? I feel like you haven't read it.
Yeah, sure. Okay, so this one says, assuming you were starting in 2025, what would your average CAGR, compound annual growth rate, expectation be for a millennial portfolio that is okay taking on slightly more risk for higher returns given a longer time horizon? So as average millennial portfolio return over the next 5 to 10 years, do you think a 10% total return compounded is realistic? I think we should clarify, is the questioner here just saying he or she is a millennial? Or because otherwise, what is a millennial portfolio?
I would guess so. Yeah.
Yeah, so the
Yeah.
return's going to be the same no matter whether you're a millennial or not. But I guess what the person is asking is if you were a millennial and you were investing in an aggressive portfolio,
Mhm.
what would you expect? And I mean, 5 to 10 years is not a long time horizon, so let's start from there. But
Mhm.
then I'll let you take that one.
Yeah, I think for a later question, we actually have some data on the probability of stocks and bonds returning above zero over 10 years. I don't have those notes for this question. So we do financial planning assumptions. We create expectations that our financial planners are supposed to use to build financial plans. Right now, for a market cap weighted global equity portfolio, it's 6.86% annualized. So that's notably a lot lower than 10%. We did do an episode 297, which I looked up when I wrote these notes, Mark. I didn't pull that out of my head. We did episode 297 on that topic, and then I also have a YouTube video, why 10% is not a realistic expected return for stocks, explaining why 10% is not a realistic expected return
It is
for
aptly
stocks.
titled. Yes.
Yeah, yeah, yeah.
It is interesting, right? Because I mean, like, there's a lot of, I mean, that Credit Suisse data is was always one of my favorite things where they compile returns over a century from every country for which they have data. And it's pretty compelling that stock returns in the US have been the best, and they had been in the ballpark of 10%. And so people were like, okay, I'm going to pick the single best country and assume that that's normal. Right? It's, how about if you look at the average and assume
Yeah.
that that's normal? And the number is a lot lower. And I mean, I think that the rule of thumb that they give, and I actually don't think this is a terrible place to start, is 5% above inflation. Right? And right now you get to not far off that 7 or so% that we're using for our expected return. Again, if you just want a rule of thumb and you want to find out whether your expectations are ridiculous or realistic, that's a pretty good place to start.
Yep. And it's no mistake that that number is close to the Dimson Marsh number from that yearbook, because we use that number as the kind of anchor of our expected returns for stocks. We give a 75% weight to that, to the 120 whatever it is something year historical return for the global market, from going back to 1900 through, at this point, 2024, I guess, for this most recent update. And then a 25% weight to the expected return implied by current market valuations. So we're a little bit lower than that historical number overall because US valuations are so high, it's pushing down the expected return number for that portion of the portfolio, which is a pretty big part of the portfolio. So we're basically expecting, I think we actually also adjust for the contribution from valuations to that historical number. So if the historical number is 5%, but 30 basis points came from rising valuations, we take that out as the starting point. Anyway, so a big part of the number though is exactly that long-term historical average.